Well, good morning everyone. Welcome back again to my channel for another chat about the action on the stock market in the last week or so. Big news over the last week was the increase in the inflation rate in America up to 9.1%, a little bit higher than what was expected. And as a result of that announcement, little fall down here, well, more than a little fall, big fall down over that period of the week, leading to, at that particular time, the market being down nearly 4%, having been up 3% in the past week. But you see the big rise that came here, particularly overnight, when we got better than expected economic data and the view that the Federal Reserve was trying to dispel the prospect of a 1% rate rise this month. Now, you know, that's a pretty massive rise, isn't it? 1%. Now, I did hear on the TV last night that some people are thinking that our central bank is also considering a big rise next month. Now, you know, that will be a bit scary for people with those mortgage rates rising at a pretty big clip at the moment. So let's keep our fingers crossed that those who've got mortgages are going to be able to manage whatever it is that the central bank does to interest rates in the next month or two. As a result of that announcement, though, that better economic data, particularly last night, then the market up by 3.5%. So overall for the week, the market in America was pretty flat, you know, down less than 0.5%. Our market, past 5 days, down 1%. A big drop down there when we heard about the inflation rate in America and a bit of a recovery on Friday. And it all comes down, I think, to what was announced in that release. That's all to do with earnings. And if companies' earnings can be increasing, then that's a positive, and so should be supportive of prices for stocks. But the counterpoint to that is the increase in interest rates and the level of debt that companies might be carrying. And that's this particular aspect of our decision making that I want to talk about today. And I want to talk about a company called Collection House, which has gone into receivership. And it pretty much comes down to their inability to manage their debt position. So let's have a look at the financials for it from Stock Doctor. And I do thank them for giving me the opportunity to share this information with you. Up until the end of 2019, Collection House had been travelling along pretty nicely, as you can see here, improving return on equity, net profit margins widening, good revenue growth, good earnings per share growth. But then the wheels fell off in a big way. You know, what went wrong? Well, who knows? Some poor decisions by the company. But the revenue, which had been growing quite reasonably up until that time, then started to fall away. And here we are over the space of 2 years, because these are 6 monthly rolling figures, falling from $160 million of revenue down to only $54 million of revenue. And in this particular period here, around 2019, 2020, the wheels not only fell off, they just ran away, never to be found again. Net profit after tax falling from $66 million down to $145 million negative. So let's have a look at around about this time, what the heck is going on with this company. Well, as you can see, that around about June of 20, they had $9 million of cash, but they had taken on a short-term loan provision of $215 million. Now that is massive compared to what their equity was, and we'll talk about that in a moment. But since that time, the debt position has always been way higher than the cash position. And so that's something which I think is worthy of taking note of. And it's a negative for the company, not something that I think, well, certainly for me, I'm not interested in companies really that have this sort of structure, more or less most of the time. So, you know, something I think that you just need to take note of and say, really, do I want to be invested in this company? You know, I had issues with this company anyway, with its business model. You know, it buys distressed debt from companies that are unable to collect the debt from their debtors. They buy those debts at a, you know, cents on the dollar, but the company is borrowing money to buy these debts. Now to me, that's sort of like compounding the issue for me. It's all a bit tricky and something that's not interesting me at all. But there we are. Look, lots and lots of debt, not much cash on the balance sheet. We can see that was what happened in December, that they've had to sell all of their investments to actually pay off the debt that they had taken on board only 6 months previously. So things had gone pear-shaped in a big way, and so they've had to sell assets to repay those borrowings they had taken on not so long ago. And in the most recent announcement, only a few days ago, we see that CLH came to the decision after exhaustive attempts to restructure the business and raise additional funding were unsuccessful. So, having sold out a whole pile of their assets, they then tried to raise funds but couldn't do so. There we have it, including multiple divestments of assets from their debt ledger book to Credit Corp and other things that they've had to get rid of. And all coming about because they were mixed up with Vault Bank, which handed in its license to be a bank. So lots and lots of issues for this company around about here, but previously had also been in some sort of strife, and in fact for a period of a year was taken off of the bourse and was not able to be traded. Now at that particular time, or in fact 6 months prior to that, just refreshing you on the financial situation for the company, had only $9.5 million of cash, had $220 million of debt, and only $73 million of equity in the business. And that gives a net debt to equity figure of 287%. Now that is very, very, very large, and so far away from my preferred metric of having more cash than debt, which means the net debt to equity is negative, that there's no way that I would ever have been interested in being invested in this company. So, need to be mindful of the debt position, I think, and this was in severe stress, I think, at that particular time. And in fact, Stock Doctor at that particular time had raised its concern to the level of distress, indicating that in their view the company was not in a very, very strong financial position at all, and in fact you would have to be very, very careful about making an investment in this company. And not only that, 6 months prior to that, it had gone from being in a strong financial position to one where they assessed it to be in early warning stages, where you want to be starting to think about whether you want to keep holding your position in the company. Now, they have a way more nuanced approach to assessing the financial health of companies than I do. I just focus on cash and debt, and that's about all I do. And that's not an advice from me that you should do it the same way that I do. But it does, concern me when you see companies that do have elevated levels of debt, and, what are they doing to manage it? Now, doesn't mean to say that having lots of debt is necessarily totally bad, but you do need to be thinking about, are they producing enough earnings, enough profit to actually manage that debt? Now, in the case of Collection House, these are their net debt to equity figures since the turn of the century at 2000. Now, it actually was in a very strong financial position, 22 years ago. But then we can see a period of time where it increased its levels of debt compared to cash and equity to the point where, it would be something that I would be having to think more than twice about before putting my money into it. Now, for a period of, 6 years there, they did stabilise that, having increased from down 20% here up to 80%. They've got it stabilised down there, and that's a good thing. And in fact, if you go back and have a look at the financials, you'll see that they were growing their revenues, they were growing their earnings, and so they were able to manage that level of debt. But then, as I said, suddenly things imploded, and here we see over the last 3 years the level of debt compared with their cash and equity has just become horrendously large, to the point now where they are going to be delisted and are going to be going through receivership. Now compare that with a company like Commonwealth Serum Laboratory, which at times has taken on debt. Now, way back at the turn of the century, did have quite a bit more cash than it did have debt. But then in that next year, they did take on significant levels of debt. But you can see over time they've managed to whittle that down. Now, At this particular time here, I would have been a little bit concerned about that and probably wouldn't have been thinking about taking a position in the stock. But you can see that over time, the company has managed that debt very, very nicely to the point where in 2009 they had got that cash level to quite a bit higher than their debt level. They then did spend some of that cash and perhaps increased a bit of debt, whatever, until we get to the end of 2012, the financial year for that, where I think for that period of like a decade, you'd have to say that the management did a great job of handling their debt situation. They then started to take on debt to grow the business. That certainly would have been a concern to me until we come through to here, where again they're showing evidence that they're starting to manage that debt and get it down to a much more reasonable level. And so, I would argue that Commonwealth Serum Laboratory, the management has a history there of managing their debt well. Mind you, if there's a sudden increase here from 48% and they take on a lot more debt, then that would be of a concern to me. Now, this is not advice for you to go and buy this stock. I'm just using it as an example of the difference between a company that has a track record of managing their debt well with a company that clearly over this period here, something, as I said, went really, really badly wrong for the company, and it's the level of debt that got them into strife. Here we have CSL, just another grab from Stock Doctor. You can see that Stock Doctor has always indicated that it's a company with strong financial health and currently trading around about $300. And I want to just talk a little bit about how it's been going most recently. Now, over the last 2 years, an investment in CSL has actually tracked sideways more or less. If you'd bought back in here at the start of 2020 in the high 200s, here we are now about $300. So there's very little growth in the company. Doesn't pay much of a dividend, so it's done no better than having your money in the bank, I guess, which has been very poor returns from having money in a transaction account. But this most recent time here is worth noting, I think. If we have a look at Commonwealth Serum Laboratory in black compared with the ASX 200 in green, you can see this very big noticeable outperformance. And so we can see that the market is warming to the company over the last couple of months. And this, in part, is a result of the performance of the Aussie dollar, which you can see since sort of the start of April has fallen from around about 76, 77 cents US down to now under 68 cents US. And the Aussie dollar has fallen by 11.3%. Now, because Commonwealth Serum Laboratory, all of its earnings are reported in US dollars, this is a very positive tailwind for the company, and in part is explaining why the share price for CSL is moving northwards compared with the Aussie market tracking a little bit southwards. And the same thing that happens with Microsoft Corporation, which is one of my holdings. If we go back here to Tuesday the 5th of April, which was the high water mark for the Aussie dollar, as I said, at around about 76, 77 cents. Microsoft has fallen by 17.4% in that sell-off of the technology space in the US. So that Microsoft has not done very well. However, on April the 5th, Microsoft was trading at $310 odd, but the Aussie dollar was trading at 0.7661 US dollars, and so once you convert to Aussie dollars, the value of that share was $405.80. If we move to July 15th on Friday, Microsoft fallen to $256.72, but the Aussie dollar at 67.92 cents means that in Aussie dollars, Microsoft is now valued at $377.97. That's only a 6.85% fall in the share price. So, if you're looking at investing in companies who report their earnings in US dollars, because they're basically getting bulk of their income from overseas, and the US in particular, then you do need to consider what you think the future might be for the exchange rate between the Aussie dollar and the US. Now, if the Fed over in the US is going to put interest rates up by, say, 1%, if they do that, that will have an impact on the Aussie dollar. And it's likely, if that happens, that the Aussie dollar is going to fall even further in value against the US. So we could be seeing the Aussie dollar trending down to, perhaps heading towards 0.65, which again will be a positive for companies like CSL or ResMed or Cochlear or these sorts of companies. Aristocrat Leisure would be another one that have their earnings over in America. So, if you're looking at investing at the moment, and I do think you need to be very careful, tricky times, we keep saying it's tricky times, I know, but, the impact of these interest rates and what the central banks do is going to be something to take into account when you are making your decisions. So remember the impact of those exchange rates on the performance of your investments. And so we'll leave it there for today. I hope you found the content informative. If you're interested in some more of my stuff, then over on the Patreon page this week, I'm looking at pyramiding into trades where you don't take a full position to start off with, and just done a little bit of back testing on one of my positions to see whether I could have done better by pyramiding into that particular position. But with that out of the way, I do hope you're keeping very well, that your investments are going okay, and I'll catch up with you again next week.